we had been holding our nerves during the downturn, and really what was important for us was to understand what's the market pricing in, and what's the upside, what's the downside on the economy, and therefore in the market. We think that right now the market's been pricing 0% earnings growth for 2020, rightly so, and probably a resumption to about 8% earnings growth next year. That would be consistent with 165 EPS on a 17 times multiple around the levels we're now. So we haven't done anything on the margin. We're always penciling in or sharpening our pencils on some of the ideas, some of the stocks that we think are being dislocated, but we've been topping some of those names. Those names can be in the healthcare sector. We've had some in the semi sector, but nothing too dramatic.
So I would describe that as nothing to see here. This quarter and coronavirus will wash out, and we will refocus as fund managers on the underlying and why that matters. Right?
So that's what the market's pricing in. That's what we think. That's what our base case scenario also is. But I do not think the markets are washed. I do not think the markets have panicked. And so, in terms of finding great ideas, we haven't had enough of a sell-off for that. So if we were to think that the coronavirus, like our downside scenario, for example, is a pandemic that has a recessionary impact in the US economy, that scenario is not priced in at all by the market right now. So we have a lot of uncertainty. And so, yes, we have a base case scenario, that's the one I've laid out, but a lot of uncertainty around that, still a lot of open questions.
Virologists and health experts are sitting and waiting for that possible label of a pandemic from the WHO. If we do see that official tag attached to coronavirus, where do markets need to reset to?
So if we were to have a containment in the same magnitude or in the same way that you've had in China, if you were to have a closure of manufacturing facilities, closure of schools, closure of businesses in the US, you could see a worst case scenario, which is not what we're saying right now is our base case scenario, but you could see a proper contraction in activity. So, and then that would be consistent with on average earnings are downgrading by about 13% or negative 13% during recession time, and so that would be consistent with an S&P 500 some 20% lower than where we are today. But again, that would be the outlier scenario.
Hi, I'm Joanna Bersecci, and thank you for watching. You can check out more of our videos by clicking on the boxes on the screen. And don't forget to subscribe to our channel for more from CNBC International. Thank you for watching.